Great. So here we are. So we're discussing this very important model called the Hamada's model. So you're told here XPLC is an oil company whose gearing ratio debt to equity is 0.4. Shares in XPLC have a beta of 1.48. They are considering investing in a new operation to build ships and have found a quoted shipbuilding company, YPLC. So YPLC has a gearing ratio of 0.2, and the shares in YPLC have a beta of 1.8. Now, my good students, I can see a situation where I've got two beta values, 1.48 and 1.8. So between those two beta values, which one is the relevant beta value? Which one is the relevant beta value that I should start using in purpose for purposes of computing a base net present value? Which one is the most relevant? Which one is the most relevant? Which one is the most relevant beta? Should I use 1.8? Should I use 1.4 or rather 1.48? Pata-potea, which one is the most relevant? We had tackled something like this in our last class, if you can remember. Which one is the most relevant? Which one is the most relevant? Pata-potea, 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 pata-potea. So pata-potea, thank you so much. Thank you so much. These students have been able, how I wish it was a face-to-face class. If this was a face-to-face class, I can tell you the guys who are saying 1.8, I would have given them a present right away, because they have been made to appreciate the fact that the relevant beta will always be the beta of the new industry that you are going into. The relevant beta will always be the beta of the new industry we are going into. Thank you so much. Ladies and gentlemen, listen and listen to me very well. Here we are. They have told us here, so we are now aware that the relevant beta is the beta of the new. We are told that they are considering investing in a new operation to build ships, and have found a quoted ship building company like that. The market return is 18% and the risk-free rate is 8%. So, ladies and gentlemen, I may not be able to get everything, but in such a question, when I see them giving me the market return and the risk-free rate of return, what do you think in this case here should come to our mind? Whenever you hear market return, you're hearing risk-free rate, what do you think in this case here should we have at the back of our mind, ringing? What do you think in this case here should we be thinking about? Somebody there? I can see two charts. When I see market return and I'm able to see risk-free, CAPEM. Thank you, CAPEM. Yes. Thank you so much. Thank you so much. Now, from there, ladies and gentlemen, I'll go right away, and we have a corporation tax rate of 25%. So then what discount rate should XPLC use to appraise the new project if it is to be financed, A, entirely from equity, and B, equity and debt in the ratio of 50-50. So let's agree one thing. What do you think? Should I do this question directly, or I give you like 3 minutes, you try the question? Should I do it directly, or I give you 1, 2, 3 minutes, you try the question yourselves? Thank you very much. I can see what you guys are recommending. At Mwalimu, let's try the question, and for sure, I give you those 3 minutes. You try the question. I give you 3 minutes. You try the question. Thank you very much. And ascertain when you are going to a new industry. So in this case here, the company is diversifying into a new industry, called shipping. So then the first thing that I will do is to calculate the unlevered beta. The unlevered beta of the new industry, which is the shipping. Great. Which model do we use? Use Hamada's model. Right? And if you remember Hamada's model, we have beta equity over a levered firm equals beta equity over unlevered firm into 1 plus debt over equity, 1 minus tax, 1 minus taxation. So first of all, I would want your confirmation that up to here, we are together. I would want your confirmation that up to here, we are together. That when you are diversifying into a new industry, that should be the first thing to need to do. You have to come and give us beta equity of the unlevered firm of the new industry. So first of all, up to here, have you been able to write up to here? Yes, thank you so much. Now come here. Slowly. These are those things ukishajua utajua AFM sana. Bila kujua itakusumbua sana. Now, XPLC is an oil company with a gearing ratio, debt to equity of 0.4. Shares of this XPLC have a beta of 1.48. So beta of this own company, beta over this company here, 1.48 is irrelevant. They're considering investing in a new operation to build ships and have found a quoted shipping company, YPLC. And this shipping company, YPLC, has a gearing ratio of 0.2, and the shares in YPLC have a beta of 1.8. Now, tell me, this beta of 1.8, how do you understand it? Is it beta equity over a levered firm or a beta equity over unlevered firm? This 1.8, which is relevant, is it beta equity over a levered firm or a beta equity over unlevered? Please feel very free. Today I would want us to talk. Today I would want our hearts to talk. Our hearts to talk. It's a heart base, heart to heart. Bila kuogopa chochote. Is it beta equity over a levered firm or a beta equity of unlevered firm? Yeah, it's levered. Thank you so much. Do you know why? It's because this shipping company, they have already told us that there is debt in here. You can see debt to equity. So it's beta equity over a levered firm. This 1.8 is beta equity of the levered firm because this firm has already debt in it. So meaning, ladies and gentlemen, that they have given us Bell. You know, Bell is beta equity levered. So Bell is beta equity levered, which in this case here is 1.8 of the new industry. We're talking of the new industry, 1.8. And fortunately for this new industry, they have given us debt to equity ratio as 0.2. They have given us debt to equity ratio as 0.2. Yeah, I'm not guessing here. They have told us debt to equity of this is 0.2. And then the other thing they have done so nicely is to give me the risk-free. So the risk-free is 0.2. What here? Somebody is 0, not risk-free, but the tax is 0.25. So tax is 0.25. And therefore, 1 minus tax will be 1 minus 0.25, which will be 0.75, like that, 0.75. Now, could you kindly plug in figures? Please plug in figures. Plug in figures in this Hamada's model. So beta equity of a levered firm here will be 1.8 equals beta equity of unlevered into 1 plus debt to equity already. They have divided for us. Debt to equity is 0.2 multiplied by 1 minus stocks, which is 0.75. So please go slowly until you give me beta equity of unlevered farm. So first of all, give me whatever is in brackets, body mass, whatever that is in brackets, body mass, 1 plus 0.2 times 0.75, right? Body mass. So we have here 1.8 equals beta equity of unlevered farm into, so this plus this. April, no. First of all, we are answering this question before we go to April 2022. Question number 1. I would want you guys to have a very strong grounding of this Hamada's model. I don't want us to take any chances. So this is a question that you are doing. And before I forget, because of my schedule, I would want to take this opportunity to send you this book right away. This is quite an important book for all of us, because these guys will always get your questions from ACC. Always, 100%. You can bet. So let me just honor my promise and send this. Actually, if I were you, I would even print this book. This book printed, you can never go wrong. So I've sent it to you guys through WhatsApp. So could you kindly give me what is in brackets? What is in brackets? Atieno has gotten a bill of 2. Before you tell me Atieno bill is 2, what is this that is in brackets here? Somebody. One, I happen to be having a calculator. I cannot see it. I cannot see it. So according to the great lady here, anasema bill is 0.9. Jackie anasema it is 1.15. So who should I trust? In whose hands am I safe? 1.15. So nani makosa umefanya, mimi najua sana. Makosa umefanya haujatumia body mass. Wewe vile umefanya umesema 1 plus 0.2 ukasema ati ni 1.2. And then this 1.2 can multiply 0. That's so wrong. You can put 0.9. That's so wrong. Normally, body mass tells us first of all to multiply. It's multiplication. Body mass. Before you add, multiply. So if I were you, I would have first of all multiplied, and then whatever I get, I add to 1. Right? And now if I do it that way, then I'll be able to get my beta equity over unlevered farm. I'll be able to get my beta equity over unlevered what here? Beta equity over unlevered farm. I will be able to get beta equity over unlevered farm. I'll be able to get beta equity over unlevered farm. So beta equity over unlevered farm will be 1.8 divided by 1.15, which will be equal to what, ladies and gentlemen? So according to Jackie, it is 1.565 or 1. Great. 1.565. So that is step number 1. This is the base. The base beta equity of unlevered farm for the industry, for the new industry. Great. Thank you so much. So at least that one up to there, we are okay. But now go and read the question and you'll be able to see now. If you read the question here, they wanted us to give them the discounting rate, which in most cases is WACC. At what discounting rate should XPLC appraise a new project if it's to be financed entirely from what year? From equity. So no worries, ladies and gentlemen. So of course I know discounting rate. They would want me to do what here? Discounting rate. They would always want me to work with WACC. They always want me to work with WACC as the rate of discounting. So in this case here, go ahead, Roman 1, and calculate WACC. So this is our discounting rate. discounting rate. But remember your debt equals what? 0. i.e. the firm is what here? i.e. the firm is unlevered. The firm is unlevered. Right? So if it's unlevered, remember in this case, ladies and gentlemen, what we used to call WASHU equals Q. Very, very important. If it's unlevered, then the weighted average cost of capital of an unlevered firm will always be equal to cost of equity of an unlevered firm. Some students sometime back here told me WASHU equals Q. No. It's WASHU equals Q. And we can prove this. We can prove this because, you know, to get WACC, so you're trying to prove here, to get WACC, we take weight of equity, cost of equity, plus weight of debt, cost of debt, into 1 minus what here? 1 minus tax. 1 minus taxation. So remember that if debt is 0, then automatically weight of debt will be 0. And if weight of debt is 0, this kills everything there. And then the other thing you're supposed to know is that if debt is 0, then equity, which automatically will be what? 1. If debt is 0, because the two must always add up to 100%. The two must always add up to 100%. So meaning something very important here happens then, that our WACC will be equal to weight of equity, which is 1, times cost of equity that we shall be looking for. So meaning that our WACC will be equal to cost of what here? Cost of equity for unlevered organizations. For unlevered organizations, ladies and gentlemen, I don't need this derivation. These are useless. For unlevered organizations, WASHU will always be equal to Q, where WASHU, this U stands for WACC of unlevered firm equals to cost of equity of unlevered firm. So wachana na hizi derivation zote. The most important thing, once in this case you appreciate this, you've already been able to bail the cat. You've been able to bail the cat. So then, ladies and gentlemen, our work really here will be to get this scale. So our work here will be to get this scale. So how do we get this scale? Then? So first of all, we know one of the functions of CAPM is to calculate cost of equity. One of the functions of CAPM is to calculate cost of equity. And this CAPM goes like this. CAPM will be equal to risk-free into expected return of the market minus risk-free. Multiplied by what here, somebody? Beta equity. Multiplied by beta equity. Great. Multiplied by beta equity. So could you kindly, ladies and gentlemen, confirm whether you've been able to write up to here? Are we together up to here? Have you been able to write? I'm not even asking about understanding, but first of all, are we together? Aha, great. So what they want us to do is to come and give them Q, cost of equity of unlevered firm, which will be equal to risk-free rate into expected return of the market minus risk-free rate into BEU like that. So Q, I have to use BEU on the other side of the coin. Beta equity of unlevered firm of the industry that I'm going into. So, ladies and gentlemen, are we aware, as this examiner given as the risk-free rate of return? As the examiner given as the risk-free rate of return? As this examiner given as the risk-free rate of return? Has this examiner given me the risk-free rate of return? Yes, it's 8% and the market return is 18%. So no worries at all. So we are being told here that the risk-free rate of return is 8% plus 18% is the market return minus 8% multiplied by beta equity of unlevered firm. So could you kindly give me beta equity of unlevered firm? Could you kindly give me now the beta equity of unlevered firm? Is there somebody who is able to recall that figure? Beta equity of unlevered firm. 1.5. We have it here. Because I'd written it like this, please allow me to use what I wrote here, 1.565 like that. So please go slowly, and then you give me the answer. Very slowly, you give me the answer. Atieno tells me, Mwalimu used 23.65%. So please don't copy our answers. Please don't copy our answers. Ensure that you are able to get these figures from your calculator. Kindly ensure you're able to get this from your calculator. Jackie has confirmed. I'm yet to get figures from Nimrod. Bansi has confirmed. So please remember it's body mass bracket first. 18 minus 8 gives me 10. 10 times this will give me 15.65%. So 15 plus this for sure will give me this. Thank you very much. Thank you very much. Thank you very much. So now we have been able to answer number 1. Now, if you allow me with your permission, now I'll be able to go straight away to number 2 of this question. So number 2 of this question, now they have number 2 of this question. I love it. Now we have some gearing. Now we have some debt coming in the equation. Now we have some debt coming in the equation. Now this time around, the financing is through equity and debt in the ratio of 50-50. No worries at all. No worries at all. Now it means that we must convert the bill that we got there into bill, because now the firm we are dealing with has debt. So the first thing we need to do here, Roman 2, first convert bill into what here? Into bill. Beta equity of a levered organization. Beta equity of a levered organization using Hamada's model. Using Hamada's model. Using Hamada's model. Using Hamada's model. So using Hamada's model, we know the formula that BEL equals who? BEL into 1 plus debt over equity into 1 minus taxation. Into 1 minus taxation like that. Into 1 minus taxation. 1 minus taxation. So then, gentlemen, remember, I have this BEL. BEL is 1.565 into 1 plus debt to equity. So could you kindly give me the debt to, I'll use the debt to equity of this scenario. The financing structure, so debt to equity, I should write to what over what? Debt to equity, I should write to what over what? Just try. There's no harm in trying. No harm whatsoever in trying. Debt over equity, I should use 50 over 50. Thank you very much, Naomi. So this should be 50 is debt, equity is 50. You can forget the percentages because they'll, okay, put them, they'll cancel. Times 1 minus tax. Are you able to remember the 1 minus tax figure? That doesn't keep on fluctuating. 1 minus tax figure doesn't keep on fluctuating. 0.25. Thank you so much. 0.25 like that. So then could you kindly give me this BEL? Give me the BEL. Give me the BEL. Mm-hmm. 0.75. So I'm being given a figure of 0.75. I would want to see whether there are other students will be able to confirm this figure. Tax, 1 minus tax, it's supposed to be 0.7. I'm so sorry. 1 minus 0.25. So it's supposed to be 0.75. Thank you. Thank you so much. Thank you so much. I'm so sorry for that. So tax is 0.25. So it could be 1 minus 0.25. So now give me the proper answer to write there. 2.739. So this is 2.739. 2.739. 2.739 like that. Now, having gotten this BEL, having worked this out with the Hamada's model, what do you think now will be the next step? What do you think will be the next step? Naomi is getting quite a different answer. Naomi is getting quite a different answer. So as I wait for Naomi to tell me, hey, I've gotten the correct one. Could you kindly guide me next? What will be the next step, somebody? Kel, thank you so much. It's cost of equity using what here, CAPM? So come and give us cost of equity. Cost of equity this time around will be cost of equity of a levered farm, because now the farm has debt. 50%. The farm has debt, so it's Kel using CAPM. So using CAPM, then this will be equal to risk-free plus ERM minus risk-free multiplied by beta equity of a levered organization. This now is levered. So could you kindly give me this risk-free? What is the risk-free? You guys have given me these figures. What is the risk-free rate of return? It is 8%. So 8% plus expected return of the market. You give me market returns as 18 minus 8% multiplied by beta equity of a levered organization. So beta equity of the levered organization is here, is 2.739. 2.739. So could you kindly give me this scale? Yeah, 35.39. I don't mind even picking my own calculator to try getting these figures. I would really want everybody to try calculating using their own calculators. If you guys are not able to get it, I don't mind, ladies and gentlemen, repeating this several until all of us get this. So then could you kindly guide me? Having gotten this scale, remember I want to get discounting rate. What do you think will be the next thing to be done? Having gotten the cost of equity, levered farm, what do you think will be the next thing to be done here, ladies and gentlemen? Thank you so much. Give us the WACC. I love that. Give us a WACC now, because already you have gotten one component of this WACC, the cost of equity of a levered farm. You have the cost of debt. You need to come and combine them. So go ahead and give us WACC, which is the discounting rate, which will be, in this case here, weight of equity, cost of equity plus weight of debt, cost of debt after tax, adjusted for taxation. I know in this question, it will be very few students who will be able to give us the weight of equity. Very few students shall be able to give us the weight of equity. Very few students shall be able to give us the weight of equity. So I'm giving you 1 minute. Try giving us the weight of equity. Try giving us the weight of equity. Try giving us the weight of equity. Let's see. Or weight of debt. So remember that the weight of equity really is 0.5 years. 0.5 years. The weight of equity here will be the equity component over debt plus equity. So the equity component, you guys gave me 50. It's 50-50. Debt over 50-50, 50 equity. All over debt itself, which is 50, plus equity, which is 50. So this will be 50 over 100, which is 0.5, like that. 0.5, like that. And then the moment I've gotten weight of equity, therefore, weight of debt will also be 0.5, like that. Weight of debt will be 0.5, 0.5. Thank you so much. So the weight of equity, ladies and gentlemen, here is 0.5. The cost of equity is what we already have here, 35.39%. Weight of debt is 0.5 times cost of debt is 8% times 0.75. I'm so sure you guys do not know, you don't know where I got 8% from. Is there anybody who knows where I got 8% from? Is there anybody who knows where I got the 8% from? A risk-free rate. Because debt, in most cases nowadays, debt is what here is secured. Debt is secured. Debt is secured, has collateral. So in the event that cost of debt has not been provided, always take it to be the same as what here, risk-free rate of return. Risk-free rate of return. So then could you kindly give me the final answer here? Kindly give me the final answer here. The WACC will be equal to 21%. 21%. Thank you so much. 21%. 21%. 21 or 20.695%. So in an exam situation, ikiletwa swali kama hii tena, hii unajua kuna kudebate. Hii hata kile kuja la semester lazima inaletwa tena. Ikiletwa, have you been able to pick some high level concepts that can easily assist you to get more than half of the marks? More than half of the marks, more than half of the marks, more than half of the marks. Yeah, more than half of the marks. But let's try one more. Let's try one more. Let's try one more. Let's try one more. Let's try one more before we go to our past paper. We try one more. At least isync kabisa. Sababu hakuna kuja kurevise tena. Sasa nyinyi tunaenda tukimalizana. Hakuna kuja kurevise hii kitu tena siku nyingine. Ni unakuwa expert. Unakuwa expert. These are very good areas. Real options, very nice for you people. Great. Example 3. Example 3. Example 3. Example 3. Example 3. You'll be able to get this from the book that I've just shared with you. Example 3. Quite an easy one. Quite an easy one. So I'm giving you 2 minutes and ensure that you're able to get this question correctly. Yeah, Mary, I've seen your question. So in this one here, we are told the APLC company has a gearing debt to equity of 0.4. Shares in APLC have a beta of 1.48. They are considering acquiring another company. They are going into new business. And the beta which will become relevant is the beta of the new business. And this new business called B Limited has a beta of 1.8. So the one of 1.48 beta of A becomes irrelevant. The one that we shall use is the one of what here, somebody? 1.8 of B company. So Mary, does that help? Mary, is that helpful? Is that helpful? Great. I can see what JS is telling me. I can see what JS is telling me. Great, great. So you only have 1 more minute. You only have 1 more minute. Please ensure that you are cooperating. You're giving me answers. Ensure that you're giving me answers. Just try, even if you get it wrong, so what? As long as you have tried. Okay. So I'll always start by, if I'm the one doing this exam, when I hear a company is diversifying to some new industry, I have the concept of the relevant beta, the relevant beta. That is where I'll always start from. So come and write in capital letters, relevant beta. Great, thanks, Atino. So write there in capital letters, the relevant beta in capital letters. The relevant beta is the beta of new industry, new company, or a new business, new business. So I start from. And this beta that they have given me is beta of 1.8 of the new business. It's beta of 1.8. It's beta of 1.8. This beta of new business is 1.8. Thank you so much. I can see it here. Beta of this company is 1.8. Then I need to ask myself, the way this thing is this new business levered or unlevered? This new business, is it levered or unlevered? You look at the capital structure given. I can see it as debt and equity in it. So it's a levered firm. And if it's a levered firm, ladies and gentlemen, then what I'll need to conclude here, what I'll need to come and conclude here is that this beta is beta equity over a levered firm, which is what here? 1.8. And the concept is very easy. That this relevant beta has to be ungeared. So that now this firm, when it goes to this new industry, they'll decide later on to bring in debt and what percent. First of all, we know that this has to be changed to BEU. So in this case here, ascertain BEU using Hamada's model. 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 So this is how Hamada's model looks like. BEL equals BEU into 1 plus debt to equity ratio, 1 minus tax, like that if you wish. So whatever we have here is our BEL, 1.8. BEU is what I'm looking for. Into 1 plus, remember everything here is about the new business, new industry, the new business, new industry, the new business, new industry. So, ladies and gentlemen, what do I have here? In this question, they have for sure given me, the debt to equity of this new business. They've told me the debt to equity is here, 0.2. So debt over equity is 0.2. Debt over equity is 0.2. Into 1 minus tax, have they given me the tax rate? Have they given me the rate of tax? Never assume it's 30%. In finance, if tax is not given, take it to be 0, 0.25. So in 1 minus 0.25 gives me 0.75. 0.75. 1 minus 0.25 gives me 0.75. So abracadabra, could you guys kindly give me what we have in brackets? What do we have in brackets here, somebody? What do we have in brackets here? 1 plus this times that. What do we have in brackets? 1.15. So this 1.15, if I make Beu the subject, it will be 1.8 divided by 1.15, which gives me the same answer like the one that you had obtained. 1.565. Thank you so much. So once I get this, then now I'm at home. Now I can easily take this benchmark to whichever situation now. To whichever situation. So this is the relevant beta. I've been able to get the Beu there, which is very good. Now from there, ladies and gentlemen, I know now the next thing, using this base, you can call it base beta, using this, now I should be able to localize. So you localize, localize the industry, the new industry, new company or new business beta to the farm, Again, here we use the Hamada's model. We localize, you localize. So now you're bringing it from the new industry, from the industry perspective to the local organization. So then if that is the case, ladies and gentlemen, what do I have? Again, I'll go back there. BEL equals Beu into 1 plus debt over equity into 1 minus stocks. So my BEL here will be equal to Beu that you guys have just given me of 1.565 into 1 plus. Now, when I look at the company that we have at the moment, I can see the debt to equity ratio of the company. I'm localizing this to the company. So I have to use the debt to equity ratio of the company. And the debt to equity ratio of the company to use, in most cases, it's normally given in the question, like Roman 1, Roman 2, Roman 3. But you see here, we don't have Roman 1, we don't have Roman 2, we don't have Roman 3. Then I have to go back to the debt to equity of the company as it was given up there. It was given here A limited. So we have here A PLC is a company with a gearing ratio of what is 0.4. Down here, watakwambia wengine, what will be the WACC if the firm is entirely financed by equity? So I know debt there is 0, equity is 100%. Here they never gave us any more information in the question here. So we shall go back to this company A, whose debt to equity now is 0.4. So we put 0.4 here. And then we have 1 minus tax of 0.75. So could you kindly give me a figure to use? What will be my BEL? Beta equity of a levered firm. What will be my BEL? Beta equity of a levered firm. In this case here will be equal to beta equity of a levered organization. Using your calculators, what will be the beta equity of a levered organization then? So this is 2.0345. 2.0345, like that. That's beta equity of a levered organization. I've been able to localize. I've been able to get this BEL. Then what do you think will be the next thing to be done? What do you think will be the next thing to be done? What do you think will be the next thing to be done? Please talk to me. What do you think will be the next thing to be done? Thank you so much. Kel, is it Kel or Keu? Is it Kel? Remember, we can't calculate Keu here. We can't calculate Keu here really, because I would have gone for Keu if they spoke of a company that is 100% financed with equity. This firm has both debt and equity. Thanks for saying this. This firm has got both debt and equity. So straight away, I'll go to Kel using CAPEM. So this one here will be risk-free. into ERM minus risk-free multiplied by the beta equity of this firm that you got up. Unfortunately, we have these metrics. Are you able to see the risk-free rate of return? Are you able to see the risk-free rate of return? Are you able to see the risk-free rate of return? I'm being told it's 8%. Thank you so much. So it's 8%. Thank you so much. Plus, are you able to see the expected return of the market? Yes. Market return here is 15%. Market return is 15%. So market return here is 15% minus risk-free, which is 8% multiplied by the bell that we got up here, which is 2.0345 like that. Then what is our KL? Our cost of equity of a levered firm will be equal to who? Cost of equity of a levered firm will be equal to who? Can somebody give us this figure? Cost of equity of a levered firm will be equal to who? Somebody 22.2415. 22.2415. Thank you so much. Like that. Thank you so much. We haven't yet hit home. No, we're still one step away from home. So having gotten these, I know discounting rates is all about WSCC. So come and now give us WSCC of this organization, which will be weight of equity, cost of equity, plus weight of debt, cost of debt, into 1 minus tax like that. Into 1 minus tax like that. Into 1 minus tax like that. Great. Into 1 minus tax like that. Great, 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 great. So I would want you, great students of mine, to give me the weight of equity here. Please give me the weight of equity and the weight of debt. Quite technical. Give me the weight of equity and the weight of debt in this question. Remember what they told us up there is that the debt to equity is 0.4. The debt to equity, they told us here. The debt to equity is 0. What here? 0.4. Debt to equity is 0.4 for the company. But you see, this is not the weight. Don't tell me that the debt is 0.4, equity is 0.6. No, no, this is quite a challenging one. When you are told here that debt to equity ratio is 0.4, you're supposed to know one thing, that this number has got an implied quotient. All the numbers, wherever they sit, they have an implied quotient, which is what here, which is 1. You see 0.4 divided by 1 is 0.4. So you're saying that debt, in short, debt is 0.4. And equity, in short, is what? Is 1. And when you want us, for example, to get weight of debt, it will be debt over debt plus equity. It will be debt here. Debt is 0.4 over 0.4 debt plus equity, which is 1 like that. So then who can be able to advise us here? What will be the weight of debt? 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 Atiro nasema 0.29. Atiro nasema 0.29. What about the other students? What about the other students? What are they able to get as the weight of debt? 0.29. So then what is the weight of equity? Weight of equity. The weight of equity. 0. What here, somebody? 0.71. 0.71. Thank you, and thank you very much. So now we have everything really come and plug in here. So our WSCC will be equal to weight of equity, which is 0.71 times cost of equity. Cost of equity, you guys had given me this. 22.2415% plus weight of debt. Weight of debt, we guys have the weight of debt. Weight of debt is 0.29. Cost of debt, not unless you're told otherwise. Cost of debt is normally risk-free because debt is secured. Debt you must give a bank security. So cost of debt is normally secured. It is 8%. Multiply this by 0.75 like that. Multiply that by 0.75. So then could you kindly go ahead and give us the WACC. Go ahead and give us the WACC. Some quite steps, but fortunately, if you go and repeat whatever questions that we do with you, repeat them. You become so good in this. You become so good in this. And then the other thing you're supposed to know, at the back of that book that I've sent you, Naomi is telling us there is a cost of debt of 7%. Thank you very much. I've not even looked at this. There is a cost of debt given. Thank you very much. There is a cost of debt given, which is 7%. There's a cost of debt given, which is 7%. So we cannot fall back to risk-free. We can't fall back to risk-free. Sorry for that. So please go ahead and give us the WACC. Go ahead and give us the WACC 24.04. And I was trying to explain that at the back of your book, the one that I've just sent there, you'll be able to see solutions being given. Solutions being given. Now, if you allow Mwalimu here, I'll give you another example from your past papers. From your past papers, they're old past papers. So it means they're old past papers. For those of you who have got this revision kit, you should be able to go to December 2012. But because I know you don't have this kit, I would rather take a photo of this question and then I send it to you guys direct. The one of best food. Sent, and I'm going to give you exactly 5 minutes. You try that question. I'm giving you exactly 5 minutes for you guys to try that question. Oh. Yes, 5 minutes. You try the question yourselves. Okay, so here we are. This is a straightforward question, very straightforward. It's a straightforward question, very straightforward. This is a straightforward question. Straightforward question. Straightforward question. It is December 2012. Question number 2C. Best company is a food processing firm, which is 100% equity financed. The company's board of directors are considering diversifying the operations by entering into the consumer's electronics industry. The current equity beta is 1.2 and 1.6 for Best Food Limited and electronic firms respectively. So between 1.2 and 1.6, which one am I going to use as my relevant beta? Which one shall I use as my relevant beta? Thank you very much, 1.6, thank you very much. So the relevant beta here is for the new industry. The relevant beta is for new industry, which is 1.6. Thank you very much. Thank you very much. And then number 2, the gearing in the electronics industry averages 30% debt and 70% equity. So tell me, ladies and gentlemen, this beta of 1.6, is it BEU or BEL? Is it BEU or BEL? Is it beta equity levered or beta equity unlevered? Levered, because we can vividly see there that the industry has debt and what year? Equity. Thank you very much. So return on the market is 25%, risk-free is 10%. Assume corporation tax of 30%. So the very first thing that we need to do, ladies and gentlemen, here for sure, is to come and get a BEU out of this relevant beta. So get BEU. So in this case here, I can even cram this. So using Hamada's model, calculate BEU of, calculate BEU of what year? Of the new industry. Calculate BEU of the new industry. So Hamada, we know it's BEL equals BEU into 1 plus debt over equity into 1 minus tax, like that. So BEL has been given as 1.6 equals BEU that we don't know into 1 plus debt over equity. Has this examiner given me debt over equity of the new industry? The new industry, which is electronics industry, debt is 30%, equity is 70%. So 30 over 70, JS, thanks. So 30 over 70 into 0. Hata uoni mali imetoa 0.7, uoni mali imetoa 0.7, ujaona. 1 minus 30%, yes. 1 minus tax is 30%. Then could you kindly come and give me the figure that we have, here? The figure that we have here, could you kindly give me this figure? So JS Atieno, wanasema ni 1.3. Thank you so much. So meaning that at the end of the day, my BEU will be equal to, meaning at the end of the day, my BEU will be equal to 1.6 over 1.3, which will be equal to what? 1.6 divided by 1.3, 1.23. JS ulikuwa umekosea JS. JS ukupata hiyo BEU ya 1.23. JS 1.23 atatoka decimal mingi. JS ukupata hiyo. Oh, you got it. You don't have figure tofauti. Thank you so much. Then that is wonderful. So after getting this BEU, now I can try to apply this BEU of the relevant new industry. I can try to apply it to the various scenarios given. Now this becomes very easy for me. So I go to the various scenarios given. Then what I'm doing now here is the localization. Now I'm localizing. So localization, we start with number 1. Localization, we start with number 1. So I've got 3 scenarios there, 30% debt and 70% equity. I would have avoided these steps, but let us just be uniform, because I can see 30% debt and 70% equity is what we have up there. I would have wanted to avoid this step, but let's just be procedural. So in this case here, localization, local is normally done using Hamada's model. So we know that BEL should be equal to BEU into 1 plus debt, debt over tax or over equity into 1 minus T, like that. Right? So in this case here, then my BEL localization here will be equal to BEU that I have here, 1.2308 into 1 plus debt is 30. Debt is 30. Debt in the question here, Roman 1 is 30 debt, 70 equity, and then 0.7. Even putting your answer ya BEL, itakuwa similar na ile nyingine tulipata huko juu. Itakuwa similar na ile nyingine ambayo tulipata huko juu. Itakuwa very similar na ile nyingine ambayo tulipata kule juu jameni. Itakuwa very similar na ile tulipata kule juu jameni. Itakuwa very similar na ile ambayo tulipata huko juu jameni. What are we able to see? What are we able to see? So wanasema ni ngapi? Somebody ile BEL at the end of the day, BEL inakuja ngapi? Jackie niambia ni 1.6, and I hope this 1.6 is quite familiar to you guys. So after localization, still in Roman 1, I know that the next thing should be CAL. The next thing here really should be CAL. The next thing should be CAL. So CAL, we are using CAPM. CAL, we are using CAPM. So CAPM is risk-free plus expected return of the market minus risk-free multiplied by BEL. We have just obtained here. So risk-free, is there somebody who is able to remember risk-free rate of return? Is there somebody who can remember the risk-free rate of return? 10. Thank you so much. So risk-free rate of return is 10 here. Plus, how about market returns? How about market returns? Market returns 25 minus 10% multiplied by beta equity over a levered organization. Beta equity over levered organization here. 6. So then could you kindly give me this scale? Kindly give me the scale. Give me the cal. So Naomi tells me, Atino tells me that this is supposed to be 34 what year? 34%. It's supposed to be 34%. It's supposed to be 34%. It's supposed to be 34%. Thank you, and thank you very much. Ladies and gentlemen, the moment I have the cal there, then what I'll do, I'll come here and calculate WACC, because really, if you read the question very well, this question was about determine the suitable discounting rate. It's WACC. So for me to be able to get this WACC very well, it will be good for me to get weight of debt first. So weight of debt is debt over debt plus equity. So the debt, I know the debt in this case is 30, all over debt again, which is 30 plus equity, which is 70. So this one will end up giving me what figure? Somebody as the weight of debt. The weight of debt will be 0.3. And for sure, once I get the weight of debt, then getting the weight of equity will not be a big deal. Getting the weight of equity, this will be a 1 plus 1. So this will be 1 minus 0.3, which gives me 0. What here? Somebody gives me 0.7. Gives me 0.7 like that. Gives me 0.7 like that. So they come and give me the WACC, which will be weight of equity, cost of equity, weight of debt, cost of debt, 1 minus tax. So weight of equity is 0.7. The cost of equity already we have this as 34%. 34% plus weight of debt. Weight of debt that you guys have given me the weight of debt as 0.3. So cost of debt, has it been given expressly or we work with risk-free? The cost of debt in the question, has it been given expressly or we, risk-free, which is 10%. We take risk-free, which is 10%, multiply this by what is 0.7. Multiply this by 0.7. Multiply this by 0.7 because of 1 minus tax. So Jackie is giving me a figure of 25.9%. Thank you so much. As the WACC. As the WACC. So from there now, if you allow me, I'll go to the second bit. I localize. So second bit is this is very easy. Entirely by equity. This is the one of Washosho and Wanogo. All right. So in this case here, entirely equity, I'm localizing. But here there is no working really. Entirely equity, I'm very bright here. So entirely equity, I know Washu equals Q. Weighted average cost of capital of unlevered firm equals Q. And to get Q is quite a simple thing. To get Q now using CAPM, I'll take the risk-free plus market returns minus risk-free multiplied by a bill. That's that. I not need a lot of workings here really. I not need a lot of workings here really. So do we have risk-free rate of return? Do we have the risk-free rate of return, somebody? Yeah, 10 plus. Do we have market returns? You guys gave me 25 minus 10 multiplied by bill that I've forgotten. Bill, I've forgotten my bill. We got bill up there. For the bill for the relevant sector. Bill for the relevant new industry. Is there somebody who can remind us what bill was? 28.45. Bill apana Mary. Give me the final answer. So the 71.23, right? So then this one here will give me what answer at the end of the day? This one here will give me what answer at the end of the day? Could you kindly give me an answer, somebody here? Kindly give me an answer, somebody here. The final answer itakuja kuwa gani? 28.45. Thank you so much. So is there anybody who has tried Roman 3? Is there anybody who has tried Roman 3 by themselves? Anybody who has tried Roman 3 by themselves? if now it's 40% debt and 60% equity. If it is a 40% debt and a 60% equity, is there somebody who has tried that? Can I give you 1 minute to try? Just the same concept, but I would want us to have it really sticking in our heads. That's the same concept. Okay, so can we do it together? Can we do this together? Roman 3. Can we do this together? Roman 3. Roman 3. Or are we somewhere? Are we somewhere? So students are giving me 23.2. 23.2. So let's try this. So first of all, it's localization. We are doing the localization for Roman number 3. Roman 3 localization. Roman 3 localization. So Roman 3 localization. Localization. So localization, Roman 3. All right. So we have our bell, which will be our bill into 1 plus debt over equity into 1 minus tax, like that. So then we have our bell, which will be equal to our bill. Our bill, ladies and gentlemen, Fatima is getting 25. Fatima is getting 25. Fatima is getting 25. Wow. Oh, great. The same. Great. So what is our BEU very fast? What is our BEU very fast? What's our BEU very fast? 1.091. Our BEU. What is our BEU? Somebody. What is our BEU? Somebody. The one that we got up there. 1.23. The one that we got up there was 1.23 into 1 plus debt over equity. They have given us the debt percentage. They have given us the debt percentage. These guys have given us the debt percentage as 40, 60. So plus 40 over 60 times 0.7. So could you kindly give me the final answer there? Could you kindly give me the final answer there? The bell. Kindly give me the final answer here. So 1.805. So once I get this 1.805, I'll be able to move to the next thing. Ladies and gentlemen, I'll be able to move to the next thing, which is the CAL for the organization. So CAL for the, I'm using CAPM. It is risk-free into returns of the market minus risk-free multiplied by the BEL of the organization. So the risk-free, are you able to see the risk-free? Risk-free is what percentage? Risk-free is what percentage? Risk-free is what percentage? Risk-free, 10. Market returns, in my memory serves me well, was 25 minus 10 multiplied by the BEL that we have here, which is 1.805. So then at the end of the day, what are we getting as our CAL? At the end of the day, what are we getting as our CAL? 37%, 37%. And then, ladies and gentlemen, go ahead and give us WD, weight of debt. So weight of debt, this is 40 over 40 plus 60. So weight of debt will be equal to what here, somebody? The weight of debt, because it's 0.4. Thank you very much. And if debt is 0.4, then weight of equity will be 0.6. Thank you very much. Weight of equity will be 0.6. Weight of equity will be 0.6. Weight of equity will be 0.6. All right. So after that, ladies and gentlemen, please go ahead and give us WACC. So WACC will be weight of equity, cost of equity plus weight of debt, cost of debt into 1 minus taxation. So now we have everything. Weight of equity is 0.6 times cost of equity. What is the cost of equity? 37%. Plus weight of debt 0.4 times cost of debt. Cost of debt is risk-free, which is 10%. Multiplied by 1 minus tax, which is 0.7. Which then at the end of the day will end up giving us what figures, and gentlemen? I want to believe what Fatima and the rest were giving me is very what here, very correct. It's very correct. Now, ladies and gentlemen, I would want us now to take the gear a little bit higher and tackle this question of June 2013, which wanted us to calculate the adjusted net present value. The June 2013 question 3B. Let me just take a snapshot of this, although it's a bit big. I hope I'll be able to capture it nicely. So great. So I hope it's something we should be able to read. I've sent something there. It reads Blades Limited is considering diversifying its operation away from its main areas of business, food manufacturing, into the plastics business. The company wishes to evaluate an investment project which involves acquisition of a molding machine that will cost $450 million. The project is expected to produce net annual operating cash flows of $220,000 for each of the 3 years of its useful life. Its salvage value is 0. The asset of the project will support debt finance of 40% of its initial cost, including issue cost. The loan is to be repaid in 3 equal installments. The balance of the finance will be provided by placing of new equity. Issue cost will be 5% for the equity and 2% for the loan. Debt issue costs are allowable for tax. The plastics industry, which is our new industry, has an average equity beta of 1.368 and an average debt to equity ratio of 1.5 at market values. So Blade Limited's current equity beta is 1.8, and 20% of its long-term capital is represented by debt, which is generally regarded to be risk-free. The risk-free rate is 10% per annum, and the expected return on an average market portfolio is 15%. Corporation tax is at 30%. The machine will attract a 70% initial capital allowance, and the balance will be written off evenly over the remainder of the asset's life and will be allowed against tax. The firm is certain that it will earn sufficient profits against which to offset these allowances. So required, using adjusted net present value, advise whether or not the project is worthwhile. Remember, ladies and gentlemen, that the first step of APV, you can remember, the first step of net present value, the first step of net present value, not net present, but adjusted present value. The first step number one is to give us NPV unlevered. NPV unlevered, i.e. discount the cash flows given using cost of equity over unlevered firm, So this really will not be a problem to me whatsoever. I will start first of all because we are going to a new industry. Ladies and gentlemen. First of all, I will start with the bell of this new industry, the relevant beta. I'll start with the relevant beta. So relevant beta of the new industry, these guys have given us for sure a figure. Is there anybody who is able to see the relevant beta of the new industry, which is the plastics industry? Is there somebody who is able to see this beta? Is there anybody who is able to see this beta? 1.368. Thank you so much. 1.368. Thank you so much. And of course, it will be Bell beta equity levered because the firm, or rather the industry, has debt. So then no problem. So in this case, then using the Hamada's model, come and give me Bell. Using the Hamada's model, give me Bell. You know, these are low-hanging fruits. Already I'm getting marks even without knowing what I'm doing. So go ahead and give us the bell now here, right? So the bell, already we have the bell, which is 1.368, which equals the bell that we are looking for, into 1 plus. Are you able to see the debt and equity? Are you able to see the debt to equity ratio of the new industry? Remember, is anybody who is able to see the debt to equity ratio of the new industry? All right. So they're telling me it's 1.5. Unfortunately, I'm getting that from one student only. Unfortunately, I'm getting that from one student only. Are they able to see that the debt to equity for these plastics? Thank you, 1.5. So what is the tax rate? The corporation tax rate is 30%. So if it's 30%, let me not waste my bracket there. Then this should be 0.7 like that. So then 1.368 equals a BEU into this and this. It gives me what figure? happen to be having another class. So you have to move with speed. You must move with speed. You must move with speed. 2.05, and then I will be able to get the famous bill by taking 1.368 divided by 2.05, which will end up giving me what figure? Somebody here. Bill will end up giving me what figure, ladies and gentlemen? .667. So now, if they want me to give this NPV unlevered, ladies and gentlemen, now what I need to do, so this 0.667, I'm being told it is correct. I'm being told that this is correct. This is correct. Beta equity of unlevered farm, I'm being told the figure is okay. So if that is the case, ladies and gentlemen, then, if that is the case, ladies and gentlemen, then what do I need to do? Very fast, remember, I want to get my KU. So could you kindly give me my KU directly here? So how do I get my KU here? So to get my KU, I know I'm going to use CAPM. So CAPM, we know it should be risk-free, plus returns of the market minus risk-free. Outside here, we have BEU, like that, unlevered, pure, unlevered. So I think if I start from here in my next session, I'll be good to go. We have covered quite a lot. I'll also share this video with you. Please rewatch this video. Try to understand this concept once and for all. It cuts across many topics, this thing. Cuts across many topics, not APV alone. It cuts across many topics. Otherwise, thank you very much. Thank you very much. Bye-bye. And please continue marketing this session. Continue marketing these special classes. They are very special. If you were in the normal class, by now to go and get normal notes. Right here, you are able to pick whatever that is needed quite fast. So please help Mwalimu market the class. Bye. Bye.